In the volatile world of precious metals investing, few events strike deeper fear than the sudden collapse of a trusted dealer, leaving hundreds of clients facing devastating losses on assets meant to safeguard their financial futures. Today, we confront a sobering chapter in the gold and silver markets where a prominent dealer has filed for bankruptcy, leaving more than 600 customers collectively owed approximately $60 million in physical bullion they may never receive. This situation exposes critical vulnerabilities in how some operations handle client funds and inventory, offering hard-won lessons for every investor navigating these timeless stores of value. The bankruptcy filing, submitted under oath in federal court, provides a transparent window into the sequence of events that led to this outcome. Detailed records reveal a deferred revenue balance reaching $49 million, representing funds received from clients for gold and silver that was never delivered. Adding to this figure, another $11.8 million appears in outstanding buyback obligations where the company received physical metal from sellers but failed to provide payment in return. Together, these amounts surpass $60 million, highlighting a profound mismatch between client expectations and the company's capacity to fulfill them. Assets listed in the filing paint an even more precarious picture, totaling between $1 and $10 million. Among these, the primary remaining resource is described as the Customer Information Database, an asset slated for sale through a court-supervised auction. This detail underscores the multifaceted impact on affected individuals, extending beyond financial shortfalls to concerns over personal data handling in the aftermath. Consider the mechanics at play. Deferred revenue in this context arises when payments arrive up front for bullion the operation has yet to source or allocate. Clients entrust significant sums expecting prompt delivery, yet the records indicate the company often operated without sufficient physical holdings to match those commitments immediately. Similarly, the buyback list reflects instances where sellers delivered metal expecting compensation only to encounter delays or non-payment that compounded the shortfall. This imbalance did not emerge in isolation. Market conditions toward the close of last year and into the current period featured notable price appreciation in both gold and silver, driven by broader economic uncertainties, inflationary pressures, and heightened demand for tangible assets. Such rallies, while beneficial for those holding physical positions, exposed structural weaknesses in business models reliant on delayed fulfillment. When prices accelerate rapidly, the cost to source replacement inventory can surge, eroding margins and straining liquidity if commissions and operational expenses have already been disbursed. Examination of the filing reveals that sales commissions ranging from 15 to 35% were disbursed promptly to representatives, even on transactions later canceled or left unfulfilled. This practice created strong incentives for high-volume selling, potentially encouraging aggressive tactics to close deals regardless of immediate inventory availability. In a rising market, representatives could secure earnings quickly while the company assumed the subsequent challenge of locating and acquiring metal at elevated spot prices. This dynamic risk turning what should have been straightforward order processing into a cycle of mounting losses. Picture the scenario from an investor's perspective. An individual decides to allocate capital to precious metals amid positive momentum, wiring funds in anticipation of receiving bars or coins that represent security against currency fluctuations. Instead, delivery timelines stretch indefinitely and communication falters as internal pressures mount. For those who consigned metal through buyback programs, the absence of timely payment transforms a routine transaction into an unsecured claim in bankruptcy proceedings. With roughly 600 affected parties, the average exposure per client reaches substantial levels, often exceeding six figures, amplifying the personal stakes involved. The core issue traces to the operational approach rather than external market forces alone. A well-capitalized dealer maintaining adequate inventory buffers can weather price rallies effectively, often capitalizing on them by fulfilling orders from existing stock and replenishing at prevailing rates. In contrast, reliance on post-sale sourcing without corresponding hedges or reserves turns upward movements into existential threats. Proper risk management would involve balancing incoming orders against verifiable holdings, ensuring that client funds correspond directly to allocated metal rather than serving as general working capital. This distinction matters profoundly for the broader precious metals community. Reputable participants in the industry prioritize transparency, swift fulfillment, and clear separation of client assets. Many established dealers ship promptly upon cleared payment, minimizing exposure windows. When extended delays become the norm, spanning weeks or months beyond standard clearing periods, prudent investors recognize the signal to explore alternatives with stronger track records of physical delivery. Historical patterns in commodity markets demonstrate that periods of rapid price discovery frequently separate resilient operations from those built on thinner foundations. Gold, serving as a monetary anchor for centuries, and silver, with its dual role in industry and investment, thrive when investors demand verifiable ownership. The principle remains straightforward. Possession confers security that paper claims or delayed promises cannot match. Those who take physical delivery into their control eliminate counterparty risks associated with third-party storage or unallocated accounts. Beyond the immediate financial implications, the impending sale of the customer database raises additional considerations for data privacy and future solicitations. Individuals impacted by this event may encounter renewed outreach from other market participants leveraging transferred contact information. This outcome reinforces the importance of vigilance when sharing details with any financial service provider, particularly in sectors handling high-value transactions. For those new to precious metals or seeking to deepen their understanding, the events serve as a catalyst for reflection on best practices. Diversification across multiple reputable sources, verification of delivery capabilities, and a preference for allocated, insured storage options when not taking immediate possession all contribute to a more robust strategy. Engaging with established dealers known for transparent pricing Secure logistics and responsive service helps mitigate similar vulnerabilities. The gold and silver markets continue evolving amid global macroeconomic shifts, including central bank accumulation, technological demand for silver in electronics and renewables, and gold's enduring appeal during periods of monetary expansion. These dynamics underscore the asset's relevance, yet they also highlight the necessity of aligning investment choices with operational integrity. Investors who prioritize direct ownership position themselves to benefit from long-term appreciation without reliance on intermediary stability. Reflecting on this case, several takeaways emerge for safeguarding one's portfolio. First, scrutinize dealer policies regarding inventory disclosure and delivery timelines before committing capital. Second, favor transactions structured for prompt physical transfer over extended holding arrangements. Third, maintain awareness of broader market signals, such as premium trends and sourcing challenges, which can indicate stress within the supply chain. Finally, treat precious metals as a core component of wealth preservation, rather than a speculative vehicle dependent on flawless execution by others. The broader industry benefits when challenges like these prompt collective advancement toward higher standards of accountability. Enhanced due diligence, clearer regulatory expectations around client fund segregation, and technological improvements in tracking allocations can strengthen trust across the sector. For individual stackers, the emphasis on self-custody can resonate as a foundational tenet, echoing enduring wisdom that true ownership manifests through tangible control. As we observe ongoing developments in this bankruptcy proceeding, the focus remains on equitable resolution for affected parties while extracting insights applicable to future decisions. The precious metals landscape rewards patience, research, and a commitment to principles that have sustained value across generations. Whether building initial positions or expanding established holdings, approaching the market with informed caution enhances both protection and potential. In closing, this episode reminds us of the enduring allure and inherent responsibilities accompanying gold and silver ownership. By internalizing these lessons, investors fortify their strategies against unforeseen disruptions, ensuring that their pursuit of financial resilience rests on solid ground. The journey toward building meaningful holdings demands diligence, yet the rewards of independence and security make the effort worthwhile. Stay informed, prioritize verification, and approach each opportunity with the discernment these markets demand. This video is for educational and informational purposes only and is not financial, investment, or legal advice. The presenter is not affiliated with any company mentioned. Always conduct your own research and consult qualified professionals before making any investment decisions. Precious metals involve risk, and past market performance does not guarantee future results. Thank you for watching.